The basics for investing in stocks. Although they are unpredictable over the short term, stocks have delivered superior returns over the long haul. Stocks deserve a place in long-term plans. Over the long run, stocks have beaten the performance of any other major asset class by a wide margin. Since 1926, stocks have returned nearly 10% per year, on average. Note that this 89-year span includes numerous wars, recessions, and the Great Depression. It also includes the severe decline in stock prices from late 2007 to early 2009, a period that overlaps what some call the Great Recession. Stocks have proved their worth and deserve a prominent place in any long-term investment plan, such as a retirement account. But because stocks are volatile, which means that by their nature, their value rises and falls, invest in them with caution. Ideally, stocks should be held to meet medium and long-term goals. In other words, money invested in stocks should not be money that you might need in 3 to 5 years. Stocks tend to deliver handsome returns over the long run, but volatile markets may not cooperate with your short-term cash needs. Common stocks represent a share of ownership in the company that issues the shares. For a description of preferred stocks, see the box on page 5. Stock prices move according to how a company performs, how investors perceive the company's future, and the movement of the overall stock market. The following is a guide to understanding stocks and how to invest in them. Different flavors of stocks. Growth stocks. Growth stocks are shares of companies with the potential to consistently generate above-average revenues and profit growth. These companies tend to reinvest most or all of their earnings in their businesses and pay out little or none of their profits to shareholders in the form of dividends. Growth companies expand faster than the overall economy, yet you can sometimes find these companies in mature industries. Note that even fast-growing companies are not necessarily good investments if their shares are overvalued. Cyclical stocks. Cyclical stocks are shares of companies whose sales and earnings are highly sensitive to the ups and downs of the economy. When the economy is performing well, cyclical companies tend to shine. A contracting economy typically hammers the sales and profits of these companies and hurts their stocks. Cyclical industries include manufacturers of steel, automobiles and chemicals, airlines, and home builders. Stocks that pay large dividends are less volatile. Defensive stocks. Defensive stocks describe shares of companies whose sales of goods and services tend to hold up well even during economic downturns. Examples of industries that are substantially insulated from the business cycle are utilities, government contractors, and producers of basic consumer products such as food, beverages, and pharmaceuticals. Income stocks. Income stocks pay out a relatively high ratio of their earnings in the form of dividends. The companies that issue them tend to be mature and have limited opportunities for reinvesting their profits into more attractive opportunities. Example: many utilities. Stocks that pay large dividends are usually less volatile because investors regularly receive cash dividends, regardless of market gyrations. Value stocks. Value stocks describe stocks that are cheap in relation to fundamental measures, such as profits, sales, cash flow, or the value of a company's assets. Stocks that pay large dividends are less volatile. Small company stocks. Small company stocks have generated better returns over time than stocks of large companies. Young small companies tend to grow faster than their larger brethren. But there's a trade-off. Small company stocks are much more volatile than shares of big companies. There are a number of ways of defining what constitutes a small company. By one common definition, a small company is one with a stock market capitalization of $1 billion or less. Market capitalization is a company's stock price multiplied by the number of shares outstanding. Foreign stocks. Foreign stocks add valuable diversification to a purely domestic stock portfolio. That's because U.S. and foreign stock markets don't always move in tandem. Foreign stocks provide exposure to overseas currencies, economies, and business cycles. Overseas stocks are divided into two subsets: developed markets, such as Western Europe, Japan, and Canada, and faster-growing emerging markets, China, India, and Brazil, to name a few. How to place an order. You place orders to buy or sell stocks through a broker. If you work with a full-service broker, you may just call your account executive and tell him or her what you want to do. If you work with an online broker, you can place the order yourself through the brokerage's website. If you place a market order, you're committing to buying or selling a stock at the best current price. With a limit order, you specify the price at which you are willing to buy or sell a stock. When and if the market price reaches the limit order price, the order is executed. Stock investors pay commissions to brokers on both stock purchases and sales. The importance of diversification. Diversification means spreading your money among many investments to lessen risk. The idea is to avoid a situation in which your investments are concentrated in so few holdings that big declines in the value of just one or two of them wreck your portfolio. If you buy individual stocks, you probably need a minimum of 20 to 30 companies from a variety of industries to provide sufficient diversification. If you choose to invest in a diversified stock mutual fund, the fund will achieve this diversification for you. More on stock funds later. For instance, you might strive for a mix of stocks that tend to fare well in different economic environments, such as strong, stagnant, and inflationary economies. Perhaps you want to blend growth and income stocks in the portfolio and add a dash of small company and emerging market stocks. The appropriate blend of stocks depends on personal circumstances, including your time horizon, when you'll need to spend the money, and your tolerance for risk and volatility, your ability to sleep at night when stock prices fall.